What is up, everybody? Welcome back to the Stock Trades YouTube channel. My name is Dan Kent, one of the co-founders of stocktrades.ca, and this week we're going to do something a little bit different because I've been on an absolute ETF binge over at stocktrades.ca. I don't invest into too many of them myself, but I do love researching them, and we provide a ton of ETF content over at StockTrades. I've been updating a ton of posts. I've been publishing a ton of new posts, comparing ETFs, the top banking ETFs, the top REIT ETFs, the top gold ETFs, everything you can imagine over at stocktrades.ca. But this week, I want to go over a specific niche of ETF, and it is Canadian dividend ETFs. I know they are massively popular among our audience, and they've actually been widely requested for me to review. So in this video, I'm going to go over a bunch of Canadian dividend ETFs, a little bit of a variety in these ETFs too, because typically they all have one main thing about them, which I'll get to a bit later here. But there's going to be a mix in this video, and I'm sure you're going to enjoy it. So with that being said, let's get to the top Canadian dividend ETFs in the country. Let's go. So one thing before we start, I'm going to drop a link in the description below where you can sign up to our newsletter, which gives you access to all these updates, all these posts. We are very much still a web-based platform. We publish a ton of written content, multiple times a week, and a lot of people on the YouTube channel are wondering how they can gain access to it. So I will leave a link in the description below. You can sign up and join tens of thousands of other Canadians getting our up-to-date information. And another thing is, I need you to comment down below and let me know if you actually like this ETF exchange traded fund content. I don't want to produce it if you don't want to watch it. Plus, if you do comment, again, you will be entered into the draw for a premium giveaway at the end of March. But with that being said, let's get into our first top Canadian dividend ETF. So the first ETF I want to go over is the iShares Canadian Dividend Aristocrat ETF. It trades under the ticker CDZ, and it is probably one of the most popular dividend ETFs here in Canada. Dividend growth investing is a widely utilized strategy by investors looking to grow a passive income stream in retirement. And with this ETF, you gain exposure to over 95 companies that have consistently grown the dividend for 5 years or longer. At the time of filming, it has a distribution in the low 3% range, and it has assets under management of just under $1 billion. So as mentioned, it is a pretty popular fund. So it tracks the S&P TSX Canadian Dividend Aristocrats Index. So this is an index fund. And in terms of its top holdings, we see things like Fiera Capital, we see things like Slate Grocery, Pembina Pipeline, Enbridge, TC Energy. You can see a lot of high-yielding companies are focused at the top here, and all these companies have also grown the distribution for 5 straight years. This is a unique one in the fact that it also does contain real estate investment trusts. We see Canadian Tire REIT, CT REIT, and Smart Centers REIT inside of the top 15 holdings. This isn't necessarily an equally weighted dividend ETF, but it is well diversified. The largest holding, as you can see, only makes up, a high 2% range of the entire portfolio, which should make it a little less volatile. And the largest exposure on an industry level is the financial sector, which comes in at around 24% of the fund. This really isn't that surprising, and it's actually one of the lowest allocations to the financial sector for any ETF I'm going to be talking about, primarily because there are so many strong dividend growers on the TSX that are in the financial sector. And, a ton of our index is made up of financial companies, oil and gas companies. So that's why you're going to see a ton of finance and pipelines in these ETFs. So because this is a fund that tracks, Canadian companies that have raised a dividend for 5 straight years, on a year-to-year basis, you're going to see changes. Companies that hit the 5-year mark will be added to the index, and ones that don't will be removed. And over the long run, this fund has outperformed the TSX. Even though it's been, relatively marginal, it has outperformed, and you're going to get a lot of dividend growth inside of this as well. So with it being a passively managed ETF, I'm actually surprised, how high the fees are. They're about 0.66%, which means you'll pay around $6.60 per thousand invested. But considering this has historically outpaced the TSX even after fees, and you've got a ton of strong companies in here that have grown the dividend for 5 consecutive years. Companies aren't going to be able to do this unless they have, strong underlying fundamentals. Eventually, if they halt the dividend growth like Suncor did in 2020, they're just going to be removed from this list, which kind of keeps it, a short list of outstanding Canadian companies. So the next one I want to go over is the Vanguard Canadian High Dividend Yield ETF. Trades under the ticker VDY, and I would consider Vanguard somewhat of the blue chip of exchange traded funds. I know iShares is bigger, BlackRock, but Vanguard is closely approaching iShares to be one of the largest fund providers in Canada. It's the go-to resource for many Canadians looking for, single click exposure to whatever industry you want at pretty minimal costs. The Vanguard High Dividend ETF is pretty much no exception. It's got one of the lowest fees out of any ETF I'm going to talk about today, only $2.10 per thousand invested on an annual basis. This works out to be a 0.21% management fee, which is crazy low. The fund's primary objective is to track the Canadian High Dividend Yield Index. So again, this is an index fund, and it invests primarily in Canadian stocks that pay dividends. In terms of holdings, as you can see, this is a fund that is very top heavy in the financial sector and primarily Canada's big 5 banks. Royal Bank and TD Bank are the only 2 companies in this fund that have double-digit weightings, and Enbridge, Bank of Nova Scotia, Bank of Montreal round out the top 5. So, as I mentioned, 4 out of 5 major Canadian banks are in the top 5 holdings of this ETF. Now, this dividend ETF is not necessarily a financial pure play, but, it pretty much is. It has over 60% exposure to the financial sector. So this is arguably the most important thing you need to know about VDY. Do not invest in it thinking you are getting a diverse holding of Canadian stocks, because you aren't. 60% exposure to the financial sector. If you're going to make this a core holding, you definitely need to understand how exposed you are to Canada's big banks and Canada's insurers. So the fund yields in the mid 3% range and is quite large, actually, with assets under management of $1.7 billion. And in terms of past performance, it has performed very well, outperforming the TSX index over the last 1, 3, and 5 year timeframes. Now, this makes sense because the financial sector was one that recovered very quickly from the pandemic. The oil and gas industry struggled. So prior to the bull run in 2022, oil had struggled significantly and dragged the TSX down with it. And now, we're seeing big tech companies like Shopify and Constellation Software kind of dragging the TSX index down, and financial companies continue to excel. So as a result, VDY has performed exceptionally well over the last while. So the next ETF we're going to go over, and it's actually one that's pretty interesting. It's a unique product, and it's a fairly small ETF, and that is the Horizons Active Canadian Dividend ETF. So Horizons, they make great funds. They're not as well known as, BMO, BlackRock, iShares. This fund only has assets under management of $107 million. I mean, typically I like to include only ETFs that have $100 million plus in AUM. So this one just makes the cut. And it's unique in the way that it is a dividend ETF. They do aim to pay a high distribution, but they ultimately aim for long-term total returns. So this is not an index fund. This doesn't track any particular index. They simply invest in companies that they believe will provide strong dividend income, dividend growth, and long-term capital appreciation. So this fund has a turnover ratio of nearly 70%. So you can tell where this fund gets its active name from. And because of this, management fees are going to be a little higher at 0.67%, $670 per $1,000 on a yearly basis to own it. If we look to the ETF's top 5 holdings, we've got things like Royal Bank, TD Bank, Imperial Oil, TELUS, and another Horizons ETF ticker with HXH. This is a index fund that aims to track the Selective Canadian High Dividend Index. It's got fairly small assets under management, I think only $75 million at the time of filming this. HAL only yields around 2.78%. So if you are somebody that seeks, high yield, you're probably not going to find this attractive. However, I felt that, a lot of our watchers would appreciate a, dividend / total return type ETF. And HAL has put up strong double-digit returns on an annualized basis since 2013. So because of its active nature, this fund, as of right now, has a ton of exposure to the energy sector. Considering this is an actively managed ETF, it does make sense. They're attempting to take advantage of rising crude and the popularity in oil stocks, along with the chances that the distributions are going to increase and, there's potential share buybacks. All that kind of stuff that is likely fueling the energy sector moving forward, and the fund is trying to take advantage of it. So HAL has, at the time of filming, 35% exposure to the energy sector. So again, much like the Vanguard ETF, HAL is something, you're going to need to consider this before you buy. If this was a core holding inside of your portfolio, you just need to understand that it does have very heavy weighting to the energy sector. But that could change. This fund could shift its strategy moving forward. So it's just, a little bit different of an approach that I decided to include in today's video. So next on the list, we have not included a BMO product yet, and they make amazing ETFs. They're coming out with, new innovations in the ETF space all the time, and that is the BMO Canadian Dividend ETF. It trades under the ticker ZDV, and this is another non-index fund ETF where the management essentially aims to invest in quality but high yielding companies. So this fund is yield weighted, meaning it is going to target higher yielding companies and give them the heavier allocations in the fund to ultimately increase the distribution. So this is exactly why, despite being one of the poorer Canadian banks over the last half decade, the Bank of Nova Scotia is currently the top holding in the portfolio. Now, following that, we have other notable high yielders like Enbridge, BCE, Canadian Imperial Bank of Commerce, TC Energy, and Canadian Natural Resources. So as a result, the fund yields in the mid to high 3% range and holds just over 50 companies. It's been around since 2011, and it has a turnover ratio of around 57%, indicating that the fund is a little more actively traded than others. But despite this, BMO is able to offer a pretty low fee. You'll only pay $3.90 per $1,000 invested on an annual basis. So in terms of performance, because it doesn't really have a benchmark, I typically look at this compared to the TSX 60 ETF, which we're going to go over next. And in this case, it has underperformed it by around 1.7% annually over the last decade. Some of this is probably because of the higher fee, but the other factor is likely chasing yield over total return. So as stock prices fall, yields rise. So with a yield-weighted portfolio, you could have struggling companies in your top holdings. But don't take this the wrong way. This is, it's full of outstanding companies. And for those who are really, willing to sacrifice potential total returns for higher yield, it's one you could potentially look at. So we've only got 2 ETFs left, and the next one we're going to go over is not necessarily one that aims directly for dividend income, but it is a very strong option for many investors, and it is one of the most popular ETFs in the world, and that is the iShares TSX 60 Index ETF. It trades under the ticker XIU on the TSX. Now, this is the oldest ETF in existence. It started trading in 1990, and it aims to hold the 60 largest companies on the Toronto Stock Exchange. So it isn't necessarily a fund aiming towards a high dividend strategy, and as a result, it only yields in the mid 2% range. But this is actually fairly impressive considering we have a lot of companies, like Shopify, like Constellation Software, that are some of the largest companies in Canada that don't pay huge dividends. So the reasoning this fund can still yield in the mid 2% range is because we have a lot of companies that are large here in Canada pay big dividends because they have wide economic moats and very strong market shares. So its largest holdings contain the likes of Royal Bank of Canada, Toronto Dominion Bank, Enbridge, Brookfield Asset Management, and Canadian National Railway. So during the tech craze of 2020 and 2021, Shopify was the largest holding in this portfolio. However, now that it underwent a massive correction, it has slid way down. And the reasonings for this is because this fund is market cap weighted, meaning the largest companies will be given the largest allocations. So the top holdings in the fund will typically have anywhere from a 4 to 7% allocation, while the smaller ones could have less than 0.5%. So this is one of the largest and most liquid funds in the country. As I mentioned, one of the largest in North America. It has assets under management of just shy of $13 billion. So this fund is, much larger than anything else you'll see here in Canada. And over the course of its existence, it has done an admirable job at outperforming the TSX. So this is likely due to the fact that the TSX has a ton of cyclical energy and material plays with it. And with XIU, it aims to only capture the largest, most blue chip ones. So with this one, you're getting a more well-rounded ETF. It does have 36% exposure to the financial sector. However, Canada's banks and insurers have proven time and time again they're well capitalized and reliable. Now, in terms of fees, this one is very cheap. You'll only pay about $1.80 per $1,000 invested to own XIU, which is why I really wanted to include it on this list, because although it does yield less, when you're paying this much less fees, that's more money you're putting back into your pocket. All right, last but not least, and this is probably the most unique dividend ETF on this list, and that is the iShares Canadian Financial Monthly Income ETF. It trades under the ticker FIE. So iShares provides a pretty unique product here for Canadian dividend seekers because it focuses not only on the Canadian banking sector, but also some insurers and asset managers. But it is important to keep in mind that this fund is not 100% equities. In fact, its most unique feature is the fact that nearly 1/3 of it is made up of preferred shares and bonds. So this does a couple of things. For one, it's going to reduce the overall volatility, except in the COVID 2020 crash. This was a little bit of a unique situation where preferred shares also absolutely plummeted. It was a pretty unique situation. These assets are typically less volatile than common stocks and can help prevent, big drawdowns. And secondly, this helps boost the fund's yield. Preferred shares are going to yield more, and this is why the distribution currently sits in the high 5% range, and it does pay out on a monthly basis. So its 5 holdings include a Canadian preferred share ETF, a Canadian corporate bond ETF, and 3 of Canada's major banks in Royal Bank, CIBC, and Bank of Montreal. So the fund aims to pay a set distribution on a monthly basis. Although it never does guarantee that the distribution will be paid, it's been extremely reliable at doing so. It's a pretty niche ETF, so fees are going to come in higher. You'll pay $8.90 per 1,000 invested, and this is what I mean with XIU. Like, you're putting on a yearly basis per 1,000 invested an extra $7.10 into your pocket. So despite it yielding less, this is something you have to take into consideration. It has over $1 billion in assets under management, so it is a very popular fund. And this is likely because of its high yielding passive income stream, along with the fact that it pays on a monthly basis. So, the financial sector doesn't have a lot of huge yielders like you'll see in, say, the energy or utility industry with, TC Energy, Canadian Utilities, Pembina Pipeline, stuff like that. This is why they aim to increase that yield through the preferred share mix and the bond mix, while still exposing investors to the financial sector. So this is a pure play on the financial sector. It's 100% of holdings, and it's a pretty unique option for, those who want a high yielding fund. So everybody, that's pretty much it for the video. Some of the top Canadian dividend ETFs in the country. I don't own any of these. They're not really my cup of tea. I aim mostly for total return. I'm not too concerned with income right now. And I feel a lot of these dividend ETFs prioritize yield over total return. But I can understand that somebody who, they want the higher yield, they want the monthly passive income, might have a lot of interest in a fund like this, because Canadian stocks, definitely with our large economic moats, in the telecom sector, in the financial sector, in the railway sector, we have a lot of high yielding stocks. And as such, they make for really good dividend-based ETFs. But remember, head down below, smash that like button, subscribe to the channel, and make sure you drop a comment to let me know whether or not you like this format of video and me discussing exchange traded funds. And with all that, you'll be entered into the giveaway for the premium subscription at the end of March. So until next time.